Welcome back to Ground Rules, where we unpack the stories behind the numbers and look at what they could mean for the decisions being made on the farm. The grain markets are becoming increasingly interesting as we head into the peak season. We've got prices starting the week quite strong, but now the big question isn't simply how much grain we have in storage, it's how strong demand remains and how quickly the supply picture could change. This week, we are looking at strong global demand. We've got geopolitical uncertainty, European heat waves, US weather, the latest WSD numbers, South Africa's next planting season, and an interesting comparison with the year 2014 and 2015 when local maize prices eventually did increase by around 50%. Now, let's take a market snapshot and start with the numbers. We've got white maize spot prices increasing to 3,585 Rand per ton this week, with the July 2027 contract declining to 3,925 Rand per ton. Yellow maize spot prices strengthened to 3,630 per ton, with the July 2027 contract increasing to 3,885 Rand per ton. Soybeans also moved higher, with the spot price reaching 7,900 Rand per ton, while the May 2027 contract is now at 7,713 Rand per ton. Sunflower seed strengthened to 10,350 per ton, with the May 2027 contract at 9,595 Rand per ton. Wheat spot prices increased to 5,988 Rand per ton, while the December contract is trading at 6,090 Rand per ton. Elsewhere in the market, sorghum import parity landed in Durban stands at 4,470 Rand per ton. The latest Randfontein export parity price for shelled Argentine groundnuts is 21,445 Rand per ton, while cotton prices increased to 11,390 Rand per ton. Now let's look at the latest fertilizer prices. Remember, these are international FOB free on board prices. They are not the final price landed in South Africa or delivered to the farm. There are still substantial freight, logistics, handling, as well as distribution costs to be added. For urea, those additional costs can amount to as much as 3,500 Rand per ton above the quoted international price. The encouraging news is that we are seeing more downward movement. Nitrogen prices declined, with Arab Gulf free on board urea currently at 5,821 Rand per ton. Potassium also moved lower, with the Brazil free on board KCl at 6,306 Rand per ton. Phosphate prices eased slightly, with Brazil free on board MAP at 13,745 Rand per ton. And ammonium sulfate also declined, with the China free on board price now at 3,234 Rand per ton. If you are currently planning inputs for the coming season and need advice or simply want to discuss what is happening in the input market, please contact Greta on 083 256 8139 for guidance on current pricing as well as market conditions. The big question, what is really driving grain prices? All right, we need to get into the bigger story because grain markets are becoming particularly interesting week on week. New information is hitting the market at such a pace that is becoming increasingly difficult to keep track of everything and also tell you guys everything that is changing. We've got prices this week that started off on the front foot with fairly sharp gains on Monday, but several forces are pulling this market in different directions. 1. Geopolitics. The war premium has not disappeared. One of the biggest uncertainties remains geopolitics. It's almost impossible to predict when the current conflicts will ease or when we could see another escalation. For now, there is still a clear war premium embedded in several commodity markets. Wheat has received renewed support from the conflict surrounding Russia and the Ukraine, as well as the tensions between the United States and Iran, which continue creating uncertainty around international trade as well as logistics. If those tensions ease, some of that premium could naturally disappear from prices. But for now, it remains something the market needs to watch very closely. Europe is getting hot, and I mean very hot. Another development that stands out is the intense heat affecting parts of Europe. High temperatures and drought stress are placing certain crops under pressure. Now, Europe isn't necessarily the dominant exporter of every grain commodity, but that's not the only thing that matters. If local European production declines, Europe may need to import more, and greater import demand could provide further support to international grain prices. The United States soybeans. August weather is critical. So across the Atlantic, August remains particularly important for US soybeans. At this stage, many of the major production areas appear to be receiving good rainfall. Interestingly, though, in some regions, the conversation is even beginning to shift from concern about too little rain to the risk of too much rain. That is currently providing some support to the soybean prices. And then there is China. We've got strong Chinese purchases of US soybeans, which is also contributing to the positive market sentiment. The latest WASDE report, WASDE being the World Agricultural Supply and Demand Estimates report, increased its estimate for both soybean acres and production. But more importantly, that doesn't appear to be what drove the latest upward price move. At this stage, demand and weather remain the more important variables. Maize, the demand story is getting bigger and bigger. The latest WASDE report also gave us something interesting to think about in maize. Estimated planted area has increased, but expected yields were revised downward. The result of that, the total estimated production didn't change dramatically. But what I found much more interesting was that demand expectations were revised higher again. And that brings us to one of the most important questions in the grain market right now. If global stocks continue declining at current prices, at what point do maize prices then have to rise enough to slow consumption and prevent ending stocks from shrinking too quickly? For me, that question gets right to the heart of this market. Demand could be one of the most important factors supporting upside potential in maize and soybean markets over the next year. And it also helps explain why then the South African prices have already started strengthening despite a very large domestic harvest and substantial carryover stocks. The market isn't only looking at what is sitting in the silos today, it's already trying to work out what next season could look like while the demand remains exceptionally strong. Back on homeland, could history offer us a bit of a clue? So there's an interesting comparison here with 2014. South Africa also came out of a good production year at the time. Then the 2015 crop came under immense pressure. And over the period that followed, local maize prices increased by approximately 50%. And the interesting part around that is that the international maize prices didn't experience a similar increase at the same time. So the South African rally was largely driven by smaller domestic crop, tighter local balance sheet, and local prices beginning to move away from export parity and closer towards import parity. Now, does that mean that we are heading for exactly the same situation in 2027? No. And that's an important distinction. We are starting this time with a larger stock buffer, which matters considerably. But there is another side to the equation. Both local as well as international demand for maize and soybeans is significantly larger today. Maize and soybeans are increasingly being used in biofuel programs, while global feed and food demand remains strong. That larger demand base means the market could be considerably more sensitive to any meaningful reduction in supply. Now, another factor, input costs. Could that change what farmers are planting? We also, cannot ignore production costs. Input costs have increased sharply, partly because of geopolitical tensions and higher energy and logistics costs. That could influence not only how many hectares of producers are planting, but also which crops they then decide to plant. And even if El Nino doesn't ultimately have a major negative impact on yields, we shouldn't simply assume that South Africa will produce another crop of more than 17 million tons next year. If the next crop is smaller, our current large surplus could begin shrinking surprisingly quickly. Now, sunflower. That could be one to watch. Sunflower becomes particularly interesting in this particular environment. There is currently strong demand for sunflower seed, which could encourage producers to increase sunflower plantings this season. And if conditions become drier, sunflower may become a more attractive option than maize in certain production areas. That could mean a larger sunflower area. Stronger demand is supporting prices for now, but there is a catch. If farmers significantly increase sunflower plantings, and we will still produce a reasonable crop, that additional supply could eventually put sunflower prices under renewed pressure. So again, this isn't a one-directional story. The question, does 5,000 Rand per ton maize become possible? Let's return to the 2015-2014 comparison. If you simply apply the same percentage price movement between 2014 and 2015 to today's maize prices, you would arrive at a price of more than 5,000 Rand per ton. But this needs to be very clear. I am not presenting 5,000 Rand per ton maize as a forecast, all right? Let's be clear. The comparison simply demonstrates how sensitive South African prices can become when a large exportable surplus starts disappearing quickly. And if international maize prices were also rising at the same time, or if the rand weakened, that could naturally provide further support. But we also need to talk about what the other side of that equation means. Like what could send prices lower? There are several real downside risks, right? If our geopolitical tensions begin easing, some of the current war premium could disappear from international prices. If the US crop turns out better than currently expected, or production improves in other major exporting countries, international maize, then prices could go down. Soybean and wheat prices could come under renewed pressure. Locally, the next crop remains critical. If South Africa once again achieves good plantings and strong yields, our large carryover stocks could remain in the market for longer and continue weighing particularly heavy on maize prices. Then there is the rand. If international prices weaken while the rand strengthens at the same time, South African grain prices could come under pressure very quickly. And remember what we said about sunflowers. Today's strong demand and attractive prices could encourage significantly more sunflower planting. But if we then plant a large area and produce a good crop, that additional domestic supply could eventually put serious pressure on sunflower prices. So what should producers be watching for now? This is why it's important not to plan around only one possible scenario. Over the next few months, I will be watching several variables very closely. Our local planting intentions and how hectares are divided between the crops, the development of El Nino, soil moisture and rainfall patterns during critical growing stages, global production, the rand, and perhaps most importantly, the rate at which global demand continues to grow. Right now, there is enough grain in the system that we are not facing an immediate shortage scenario. But the demand side of the balance sheet makes this market far more interesting than the sheer size of the current crop might suggest. So, what is this week's ground rules takeaway? The next few months are going to matter enormously, all right? On the supply side, we need to watch El Nino. We need to watch South African planting intentions and how producers are dividing hectares between maize, sunflower, and other crops. On the other side of the equation, Strong local and international demand is likely to remain an important source of price support. For now, this is not a simple shortage versus surplus story. It is a market where large stocks are meeting very strong demand and where any meaningful change in supply could cause prices to react very quickly. And remember that reaction can go in either direction. A weaker crop could support prices rapidly, but a good crop, improved global production, and a strong rand could just as easily put them under pressure. So do not build your marketing or your planning strategy around one headline or one scenario. Watch the balance between supply and demand, because that's where the next big market move is likely to begin. If you are watching this for the first time, we would like to let you know that we are serving one market, two languages, and better informed decisions and better informed farmers through AMT and GroundRules, which have joined forces to take trusted agricultural market intelligence even further. AMT brings you the market updates in Afrikaans, and GroundRules brings it to you in English, all powered by the same trusted AMT data as well as insights. Thank you for joining us for another GroundRules grain market update. Until next time, stay informed, stay curious, and remember, the best farming decisions always start with solid ground rules.